Banking Law and Practice. Chapter 2. Paying and Collecting Banker. Part 1. Nature of Banking Business. A bank's main job is to collect deposits from people and use that money for lending or investment. Section 5(b) of the Banking Regulation Act, 1949 says banks must collect deposits from the public and lend or invest that money. Banks collect two types of deposits: time deposits, kept for a fixed period, and demand deposits. You can withdraw anytime by check. Demand deposits are kept in current accounts or savings accounts and can be transferred using checks, RTGS, or NEFT. Banks lend money in different ways: cash credit, overdrafts, loans, and purchase of bills. Banks give secured loans, backed by collateral, and unsecured loans, given without any security. Paying banker, meaning. The paying banker is the bank that pays a check when a customer presents it. When you deposit money in a bank, the bank has a duty to return it when you ask for it in writing. The bank that pays the check is called the paying banker or drawee bank because the check is drawn on it. Section 31 of NI Act, 1881 makes it a legal duty to pay the check if the customer has enough balance. If the bank refuses to pay even when money is available, it must pay damages to the customer for the loss caused. If the bank pays by mistake without checking the balance, that loss falls on the bank, not the customer. Precautions before paying a check. Set 1. Before paying a check, the bank must check a few important things to avoid mistakes. Proper form. The check must be in the bank's printed format and must be in unconditional order. A conditional check is not valid and cannot be paid. Physical condition. The check must not be torn, mutilated, or canceled. If it looks deliberately damaged, the bank must get confirmation from the drawer first. Crossing. An open check can be paid across the counter, but a cross check must only be paid through a bank account, not directly to the person. Special crossing. If the check is specially crossed, payment must be made only to the specific bank named in the crossing, no one else. Office of drawing. The bank must check which branch holds the account. Under core banking, any branch of the same bank can pay the check. Precautions before paying a check. Set 2. The bank must also check the date, time, amount, and signature carefully before making any payment. Date. The check must have a valid date. Stale checks, older than 6 months, and undated checks must not be paid without the drawer's confirmation. Time. The check must be presented during banking hours. Paying after hours removes the bank's legal protection. Amount. The amount written in words and figures must match. If they differ, the bank usually refuses payment to avoid any problems. Material alteration. If any visible change is found on the check, the bank must get the drawer's full signature at that spot before paying. Signature and endorsements. The drawer's signature must match the bank's records. Forged signatures must be refused, and all endorsements on the check must be regular and valid. Legal restrictions. Countermanding. Countermanding means telling the bank in writing to stop payment on a check you already gave to someone. You can stop a check anytime before the bank actually pays it, but the instruction must always be in writing. The bank cannot act on a phone call or verbal request. A written stop payment instruction is required. You must clearly mention the check number. A vague instruction can confuse the bank and lead to the wrong check being stopped. Only the drawer can countermand a check. The payee who received it cannot ask the bank to stop payment. If the bank ignores a valid stop payment instruction and pays the check, the bank is responsible for the loss confirmed in Burnett v. Westminster Bank Ltd. Death, insolvency, lunacy, and garnishee order. Some events automatically stop the bank from paying checks, even without any instruction from the customer. Death. Once the bank hears about the customer's death, even through a newspaper, all payments must stop immediately. If the bank was unaware and paid, it gets legal protection. Insolvency. The bank must stop payments only after receiving a formal notice of the insolvency petition. Rumor or suspicion alone is not enough to dishonor checks. Lunacy. The bank must stop all operations only after receiving clear proof like a doctor's certificate or court order. It cannot assume insanity and dishonor checks on its own. Garnishee order. If the whole account is attached by the order, all payments must stop. If only a specific amount is attached, the remaining balance can still be used. Sufficient balance. The bank must always check that the customer has enough money in the account before paying any check. If the balance is not enough, the bank must refuse the check. It cannot pay even a part of the amount. When checks arrive at different times, the bank must pay them in chronological order, regardless of the check number or the amount written on it. When multiple checks arrive at the same time but funds are short, the banker must decide which to honor. This is entirely the banker's call at that moment. Checks from government bodies or tax authorities must always be paid first over any other checks. Only today's actual balance counts, future deposits, checks sent for collection, and anything beyond the approved overdraft limit are all excluded. Statutory protection I. The NI Act, 1881 gives the bank legal protection, so it is not held personally liable for every payment made in good faith. Without this protection, the bank would have to verify every endorsement on every check, impossible with hundreds of daily payments. Section 85(1). If an order check with a forged payee endorsement is paid, the bank is protected as long as the endorsement looks regular and payment is in due course. Section 16(2). Even if the endorsee's signature is forged, the bank is still protected as long as the endorsement appears regular and payment is in due course. Section 85(2). Once a bearer, always a bearer, the bank is discharged by paying a bearer check to whoever holds it, but there must be no suspicion about the bearer and the check must be open, not crossed. Statutory protection II. 3 more sections protect the bank when it comes to drafts, cross-checks, and altered checks. Section 85(a). If a bank draft with a forged endorsement is paid, the bank is protected as long as the endorsement looks regular and payment is in due course. Section 128. If a cross-check is paid in due course, the bank is protected and is treated as having paid the true owner, even if the actual receiver had a defective title. Section 89(1). If a materially altered check is paid, but the alteration was not visible even after careful examination, the bank is fully protected. The key condition for all these sections is that payment must qualify as payment in due course under Section 10. Without this, no protection is available. Payment in due course. Payment in due course means paying a check honestly, carefully, and to the right person as defined under Section 10 of the NI Act, 1881. As per apparent tenor, the bank must pay exactly as the check instructs, no partial payments, and a cross-check cannot be paid across the counter. Good faith and no negligence. The bank must be honest and careful. Paying without properly checking the check's contents counts as negligence. Right person payment must go to the legal holder, the payee or endorsee for an order check, or the bearer for a bearer check. No doubt about the payee. If the bank suspects the person is not entitled to the money, it must inquire before paying. Ignoring suspicion removes protection. Money only payment must be in legal tender money. A bill or promissory note is accepted only if the payee agrees to receive it in that form. Mandate. A mandate is a simple written authority that allows another person to operate a customer's bank account on their behalf. A mandate is written on plain paper, no stamp duty is required, and is usually collected when the account is first opened. The authorized person, mandatory, can sign checks, withdraw cash, or operate lockers exactly as specified in the mandate. The bank must follow the mandate strictly. Any deviation from what is written can create serious legal problems. The mandatory cannot pass this authority to anyone else. The power given is personal and cannot be delegated. The mandate automatically ends if the customer dies, becomes insolvent, or is declared a lunatic. The bank must stop mandate operations immediately. That's a wrap on Part 1. Watch Part 2 to learn about the collecting banker. Like, share, and subscribe for Ria's notes for more notes. BCom BBA BCU SEP syllabus.